Hello everyone and welcome to another episode of Monday Market Outlook. So last week, another bank entered into the financial crisis story. This time Deutsche Bank may be the next bank in trouble, right? Because after Deutsche Bank shares fell by as much as 20%, there was a massive surge in the availment of credit default swaps. Now, credit default swaps are basically insurance. It's a financial instrument that insures investors against a default. In this case, many investors are trying to insure themselves against a possible default by Deutsche Bank. What's up there? We don't know, right? They may have inside information that we don't know of, but this has caused some alarm in the financial sector. So let's look at the financial ETF. Technical analysis can just be as easy as this, right? Two horizontal lines and a chart, right? No, this one horizontal line here, this orange horizontal line here is a classic example of a support and resistance switch. This critical zone here at 31 has been a resistance point for the longest time until it was broken in 2021, and that has ever since served as a support zone for the financial sector. The financial ETF is currently hovering at that critical zone. Further weakness in the financial sector might cause the XLF to breach this support zone, and if it does, we are looking at the financial sector to possibly fill this gap and settle at 25, no? So now that represents like a 16% drop in the financial sector. So this is something that we will have to be on the lookout for next week, and hopefully next week the XLF closes above this support zone. Now going to the PSEI chart, the index was able to breach this very critical area here. This bodes well for the market next week. While a test of the 61.8 fib may still be possible in the future, we need to look into this breakout of this critical zone here, which might move the market to retest 6,700 next week. Chances are, once it hits resistance at 6,700, we may see a move downwards to retest this critical zone here. Some swing traders may have gotten during this low. You may want to look at this zone and take some profits off. Let's look at some chart requests from our comments. Let's start with Converge. No, so here is the Converge chart. No, every time I look at a chart, the first thing I do is look at your moving averages. Exponential moving averages, 20-day, 50-day, 100, and 200, right? So again, 20, 50, 100, 200, exponential moving averages, right? So look at Converge, right? So what do moving averages mean? It shows you the trend. Converge is trending downwards, right? So every time a price action is below moving averages, look at all these resistances that the price action has to overcome. This is why Converge is having a hard time breaking out, right? So the longer the moving averages, the stronger the resistance, right? So having broken through 20 EMA, 50, it had trouble breaking out of the 100 EMA. Again, another attempt, it had trouble breaking out of the 200 EMA, right? And it's now again below all the moving averages, right? So it needs to have more strength to overcome 200 EMA for you to even consider Converge, right? Fundamentally, Converge is not a bad company. 27% profit margin, 26 billion, 7 billion in revenues, right? Quarterly revenues, technically it is very weak. Wait for it to overcome the EMA resistances first before going in. Now, if we want to draw some horizontal lines here to further identify some key areas, right? So we have here 1850, a key area. See, okay, there are some activity, there's a lot of activity happening here, support also and resistance here. So Converge has to overcome this critical area here for you to start looking at it seriously. Another area here that we can see may be a resistance point here at 22. So if it breaks out, the next area of resistance could be 22. Okay, this is support becomes resistance, right? So very classic support and resistance role switches, no? Now, in contrast, Converge in contrast, another request from our reader, SMC, right? Look at how it was able to successfully break out of its 200 EMA, right? And once it broke out, look, the sky is clear, right? To the moon. Ever since it broke out, SMC was able to hold itself above its EMAs. I would like to see San Miguel, right, retest 100 or 200 EMA and hold itself above those levels to further confirm that it's going to stay above 200 EMA, right? So let's draw some horizontal lines here. See, this is a critical zone, right? This is a critical zone here, right? Now, another critical zone here is... Another critical zone here would probably be this area, right? Now, let's look at this horizontal line here. See how it corresponds to the 200 EMA, right? So this was a very strong resistance for San Miguel Corp, and what this is called is a confluence zone. So there's the horizontal line, support becoming resistance. There's also the 200 EMA. So there are two confluence zones in that area holding San Miguel Corp. And if it breaks through that very strong resistance, that means that the stock has strength, right, going up, which is shown in this chart, right? So the next resistance here was supposed to be at 103, and it also clearly broke out of that. Now let's look at the top resistances. We have here possibly 118, right? And then another one here at 122, right? Now we can also look at its Fibonacci chart. Every time it goes up or a stock goes down, you can draw a Fibonacci chart from the peak to the throw, right? Where are the resistance zone and where are the support zones here? It's usually the 0.5 fib and the 0.6 fib. Look at how the 0.6 fib corresponds to what we drew here. So it really makes sense, right, for San Miguel to retest these zones. So again, we have a confluence here. 68 fib, 200 EMA, and see a previous support and resistance line, right? So this zone is very critical for San Miguel Corp. So look for SMC to retest these zones and confirm that it will stay above 200 EMA. Fundamentally, San Miguel Corp is a 1.5 trillion peso company, right? It made headlines during its earnings call because it hit 34 billion in profits, 16% up year on year, right? So look at this breakout. This is Feb 2. The earnings call was March 15. So I don't know, maybe insiders did have some advanced knowledge of that and brought the stock up. So going into the global markets, as expected, the Fed hiked rates by a 1/4 percentage points, right? But something interesting in what J. Powell said, that he hinted a potential end to rate hikes this year. He referred to the banking crisis as something that is helping the Fed fight inflation, in the sense that the financial crisis may cause some weakness in consumer spending as well as the labor force, which may help with the Fed's fight in inflation. If you look at the dot plot, we now see a potential 5.1 terminal rate for 2023 here. Look, right? And then the Fed looking into either 4.1 or 4.6 by 2024, and mostly a divided Fed for 2025 ranging from 2.6 to 3.1, right? Now, whoever this guy is, wishing to keep the Fed funds rate at 5.5% until 2025, I don't know who you are, dude. That's not gonna happen. I don't think that's going to happen, right? What does the market say about all of this, right? So this is the Fed funds futures. The Fed funds futures is the forward indicator of where the market thinks that the Fed funds will be in the near future, right? We are currently here at around 5%, and the market is betting that we will be at around 4.4% in the near future, right? So this means that the market is betting that the Fed will pivot this year instead of holding rates up for 2023. Why are they betting against the Fed, right? Let's look at the 2-year yield, right? And then let's look at the monthlies, right? This is the first time that the 2-year Treasury yield broke its support level here. This is a big candle that broke this support, right? Now, it hit resistance and then it went down. Now, if we put in the Fed funds rate, right? The effective Fed funds rate, and compare it with history, right? Every time that the 2-year yield has broken support levels here and shown a decrease, the Fed starts to pivot. Look here, right? Going down, Fed pivots. This went down, the Fed pivots. This went down, the Fed pivots. This broke support, right? So are we seeing the Fed do this? Because we already have an indicator here. So remember that every time the Fed pivots, that means that something is already broken in the system. And when something breaks in the system, that means that the markets tend to go down and experience a new bottom, right? So we will try to monitor this chart every month and see. Hopefully, this gives us a sense of what's coming and we can try to anticipate. People have been asking me, why are the markets going up despite all this banking crisis and negative sentiment? The explanation for that is that, contrary to what the Fed is saying, Fed tightening and all, the Fed has been embarking on a massive infusion of liquidity into the market. Let's look here. The Fed has kept on pumping liquidity into the markets, especially during these last few days. Look at this. Look at the spike at the end, right? Now, this massive infusion of liquidity is lifting the markets up. Let's revisit the smart money and the dumb money chart. See how smart money is not dumb after all. See how smart money came in aggressively when the market bottomed at this point, right? So they went in along with the Fed funds infusion and rode the market rally up to where it is today, right? So it's a combination of central banks infusing a lot of liquidity because they're trying to save the banks, right? So they're infusing a lot of liquidity. Smart money knew about it, came in, rode into the rally, and this explains why the market is going up. Now, if we look at the options chart here, this is the options chart for this Friday. A lot of people were betting against the market going down, but see how Wall Street is able to maneuver the market to its maximum pain, right? This is maximum pain, 395, and the markets ended right there. So that's why we're always looking at the options chart, because it gives us an indication of where Wall Street, of where the market may end, right? So looking at next week's options expirations, you have here 410, 400, and 390 as your extreme zones, possible extreme zones. Maximum pain still at 395. So we're looking at potentially see the markets again settle at 395, back to where we started. Now, how can the markets move? It may move towards 410 before circling back to 395. So what does it look like in the charts, right? So let's look at the SPY. Look at how well Wall Street maneuvered the S&P 500. Extreme zones, 400, 400 and 393, and look at where it landed, right there in the extreme zones, right? So if we're looking at the next extreme zones, 400 and then 410, 400 and then 410, right? Look here, again, this coincides pretty well with the gap fill that we were trying to anticipate. So we can look at the market maybe pushing towards this gap fill before circling back to 395 eventually. Now, if we look at the S&P futures, right? So let's clean up some of the lines here. So we were anticipating a retest of this trend line resistance, and it did retest that resistance. However, it was able to hold itself above this extreme zone here based on options, right? So we can delete this for now. So we can see a further retest of this confluence zone here, and if it breaks out, the next movement will be here, right? Again, this is our extreme zone 410, so we can approximately here, but it may not reach there. This might be a good area for the S&P 500 to settle, right? So 410, 390, right? 390 extreme zone here, and then 4,000, right? Is it possible for the market to move up, retest, gap fill, breaks out of its trend line, then goes down? Let's extend this trend line, goes down, retest this trend line, and eventually end again at 395. So again, if we go back to the PSEI chart, it is not exactly impossible for the PSEI to also follow that movement. Looking at the economic calendar for next week, we have the consumer confidence, GDP, and the core PCE price index numbers, no? So of course, we are anticipating a slowdown in the GDP as well as a reduction in consumer confidence. Jobless claims, of course, the Fed is looking for more people to run out of jobs, and price index to reduce month on month to 0.4 from 0.6. So thank you very much for watching. I hope you found all this information useful. Please like this video and subscribe to the channel for more updates. Again, good luck on your trades. Please manage your risk accordingly, and I'll see you again next week. Bye-bye.